Hey, Bulls and Bears, we are back with another dose of economic reality. It's been a couple days, or no, just one day. I missed yesterday, but I'm back. Thanks for being here. It is Wednesday, July 26th, 2023. Back with another round of economic collapse news slash financial news roundup, basically. So we're going to cover a little more today than usual. We have obviously the big news is the rate hike. So now we're at a 22-year high for this funds rate. And there were people saying that the Fed wasn't going to cut rates because things are starting to deteriorate with the loans and the uptick in defaults and the late payments and people getting further behind on their credit card payments. But I've always said here, they're painted into a corner. They're between a rock and a hard place. You know, pick your wording for this. But they're in a very tough position because if they don't raise rates with inflation where it is, remember they have a 2% inflation target. So their back's against the wall. They need to raise rates. Otherwise, they're going to lose even more credibility than they already have. And they've already lost a lot of credibility. I mean, after 2008, people thought that things were solved, that we wouldn't see the cost of living skyrocket again. We wouldn't see home prices get to these levels that they're at now. Home prices are so high now. People are looking back at 2008 and they're saying that wasn't the housing bubble because home prices are so much higher now. People are saying 2008 wasn't even a housing bubble. But after 2008, especially after prices corrected, 2012, 13, 14, 15, up until just recently, everyone agreed and acknowledged that that was a housing bubble back then. I mean, there's been books written about it, the housing bubble. There's been probably millions of articles written about it, the housing bubble. Now, that wasn't the bubble, because prices now are even crazier. So it's wild times here, folks. We're going to get into home price information here in just a little bit. But this Fed hike, it had to be done. I really strongly felt they were going to do it. Some people felt that something big was going to break or the markets might start dropping and that somehow that might make the Fed pivot. By pivot, meaning either pause or backtrack and completely start dropping rates, which would be insane when you have not even gotten inflation under control yet. Now, of course, they're trying to tell us that inflation is beginning to be under control or to get under control, but we know that's not the case because they're looking at year-over-year numbers, and the year-over-year number that we're looking at is already higher than the previous year, right? So that's a very interesting way that they use to gauge inflation. But all you have to do is look at your bill, your budget, and you know that the cost of living is out of control. Now let's talk about the stock market. The stock market was actually mixed today. Dow Jones was in the green, NASDAQ down slightly, Russell 2000 in the green, S&P 500 down slightly, so pretty flat and mixed. But there were people speculating that this rate hike was going to be the straw that broke the camel's back, that the markets were going to start collapsing after this. Remember, the effects of the rate hikes are not seen until months and months and months down the road. And that's why I've always said here in the markets that we watch, in car prices and home prices, that this is a slow motion collapse. Even though they've raised interest rates, very dramatically, things still take a while to play out. You start seeing people get behind on their loans. They do balance transfers and they try to get a lower interest rate, refinance. And, now that option is off the table with the lower interest rate because of just rates are so much higher. We're over 21% on your average credit card APR right now, and all the debt that people are carrying. It's going to be absolutely outrageous, I think. It's going to be shocking to a lot of people, what's going to happen. But then again, keep in mind, they could always intervene and they could stop natural market forces from happening by pausing payments and by stopping foreclosures and stopping repossessions, all those things that they can do to intervene in the markets, right? So we'll have to see what happens from this, but please let me know your thoughts down below on the rate hike. Is this the one that's going to make things start speeding up as far as this collapse, this correction? Please let me know down in comments. More bad news economically here. U.S. manufacturing slump deepens. U.S. manufacturing slump deepens. This is out of Reuters. This is another bad print here. Manufacturing PMI drops to 46, and that was down from it was 46.9, almost 47 in May. Factory employment declines, companies reporting layoffs. No surprise to anyone here watching this channel. Now, of course, they're going to try to divert people's attention. They're going to say, no, look at the low unemployment number. And, we know that that's a flawed number. We also know that the people that are employed, a lot of them are working 2 and 3 jobs just to barely keep up and still not keeping up in some cases. Imagine working 2 jobs, maybe even 3 jobs, or just say 2 jobs. And yet you're still going deeper in debt every month. You have to rob Peter to pay Paul while working 2 jobs. That's what's happening for tens of millions of U.S. households. There's not a study on that particular topic, but I'm sure if there was, it may be even most people. Most people do live paycheck to paycheck. We know that. But what about the people that are working 2 jobs? I shouldn't say most people. Most people don't work 2 jobs, thank goodness. But the people that are working 2 jobs, are they climbing their way out of debt? Are they staying out of debt? Or are they getting deeper in debt? Or are they barely keeping their head above water? I mean, it's something that's very common. I talk to people every day at my job, and I know the situation out there. And that's why, in addition to this reporting that we do, when we see the numbers, we see the news, and then the people that I talk to every day at my job working in finance, I know what's happening. I know what's happening on Main Street, but yet they want people to focus on Wall Street, focus on the stock market. And remember, we always have to, every week or two, I try to point this out. People need to remember the stock market is mostly owned by the top 10%. Close to 90% of all stocks are owned by the top 10%. Once you know that, then you know this market is completely controlled by the mega wealthy. And when they decide to bring it down, they'll probably all know beforehand, and they'll all get out before the carnage hits. So the timing, that's the tough part, to try to predict or to try to forecast. Now back to the rate hikes here for just a minute. In our previous report, maybe 2 reports ago, we talked about how you can park your money now and get almost 6%. I believe it was 5.5%, 5.75% on a CD with some of the smaller banks there. A couple credit unions were offering that rate. A few, actually, if you look around, you'll easily find that rate, I think. You may have to go online to get it. But will rates hit 6% now for what you're going to yield on these interest-bearing accounts, CDs, money market accounts, even some savings accounts offer interest. And, so it's a good time to be in cash on one hand, but on the other hand, you have the threat out there of what's happening with the BRICS nations and the implementation of gold within the monetary system and within the trading of all these BRICS countries, right? So it's a time of definitely not just uncertainty, but you have to kind of look at the big picture right now, because just sitting in cash when you have the dollar out there that's basically under attack, is also risky. Now, I do happen to have still dollars sitting and getting interest right now in the money market, but also you want to be diversified. You've heard that word. If you invest, you've heard that word diversity probably for decades. So the thing that makes me feel good and that I have is also some precious metals. I just bought another round of metals. I got, I believe, 20 silver 1-ounce coins just a few days ago. So that's, what I continue to do. It makes me feel sleep better at night, knowing that I'm not all in dollars, but also if you have some dollars, you're making some money right now on interest. So if you're positioned right now, it's a good time to, maybe even gain some wealth during this time. Also, let's talk about what was basically forecasted too, and that was going to be the door is still open to even more rate hikes. So, their backs are against the wall. They have to pretty much raise rates, even though there's small rate hikes, just to maintain any level of credibility, in my opinion, on these rate decisions. All right, let's get into housing now a little bit here. Wolf Street's out with another nice report here on this housing bubble 2.0, which some people say is not a housing bubble even now, but I think in a couple of years we're going to look back and say, yeah, this definitely was a housing bubble. Housing bubble update, they're talking about the Case-Shiller numbers. Now, we went over a lot of these numbers, I think a week or two ago. But here are some numbers here. The 20-city index put out by Case-Shiller is down year over year now. So the largest 20 cities that they're tracking in that index are negative year over year. So if you're someone that bought at the peak, you're already underwater. So if you had to take out a loan You're not going to be able to sell and pay off your loan. You're not going to be able to refinance because rates are higher. So a lot of people are stuck. And again, we're not going to see this fully play out for a while. And, the bottom may not even be here for a few years in this housing market. So it's going to be very interesting to watch. But they did give us a few cities out of here that were down the most. We see Seattle. Seattle, if you look at a chart here, it's down big time. And what do we have here? Down 11.3% year over year. We've got next Bay Area, San Francisco, down 11% year over year. Las Vegas down 8%. Whew. Imagine buying at the peak in Las Vegas. You're sitting in 110-degree temperatures on some days, and you're already negative equity. Same thing with Phoenix, down 7.6% year over year. Portland, Oregon, 5% year over year. Denver down 4.9% year over year. San Diego, where I'm at, 4.2% year over year. Now, I did read another report that it was closer to 10% if you look at it county-wide, because San Diego County is where San Diego's at. But I think this might be just the city. So just the city, the downtown area, 4.2%. Dallas, 3.8%. Los Angeles, 3.1%. And Washington, D.C., down only 0.1%. You have a lot of rich politicians living there. So politicians are a lot of times immune to economic downturns because they get paid so much. Many people would say too much. All right, now still on the topic of housing, let's talk about rents and what some renters are having to face. This is a story out of Fox 5 Atlanta. Atlanta seniors shocked by unexplained late fees threatening eviction notices. So several people that say they paid on time are getting these threatening letters telling them that their rent didn't show up on time. So I'm not sure if these people mailed it in and maybe the mail took longer than expected, and maybe the landlord said, oh, it arrived 2 days later, whatever. It doesn't get into that type of detail. It doesn't matter. Anyway, they're saying they got these letters and basically threatening them. Quote, they sent me a letter, a threatening letter, first of all, indicating I owed a certain amount of rent and that I was behind. They told me they wanted me out the next day by 10 a.m. That was a 75-year-old that said that. Imagine just being late 1 or 2 days. You send your rent in and maybe the post office loses it. Maybe they deliver it too late. And then they want you out the next day, right? I think there's going to be some laws that they're going to have to put in here once this thing really starts picking up, just like in 2020, when so many people couldn't pay their rents. We're headed that same direction now. And people, often wonder why this collapse is such a slow thing to play out. Well, remember in 2020 and 2021, people ended up accumulating a record amount of savings. So now that savings has been depleted. Whoops. That savings has now been depleted. I knocked a headphone off the shelf over here. The savings from those times with the stimulus checks and when things were shut down, people didn't have many options of going out and spending money. People weren't traveling for the most part for a while. We had a record amount of savings, but that's been depleted now. And now we're down close to a record low in the amount of savings that the average U.S. person has, right? So it's a very dramatic shift. And if it wasn't all the stimulus that was handed out over the past few years, this downturn would have taken a much steeper and harder turn than it has. But, when people had all this extra savings, it's going to take longer to play out now because they had to deplete the savings. We're there now. The savings is depleted, and now we're getting lower. We're kind of bouncing along the bottom right now, close to all-time lows as far as the savings rate goes. So another reason why it's a very slow motion thing playing out here. But these seniors are definitely stressed out. Imagine being in your 70s and all of a sudden you get an eviction letter, and it's not easy to move your whole residence no matter what age. I guess when I was back in my 20s, it was pretty easy to move. I fit everything in a little SUV that I owned back. I had a blow-up mattress. I didn't want to get myself in a lease, so I would just go from here to there and do monthly rentals and stuff like that, rent rooms and stuff like that. Quote, when I went in to talk to her, she said I had 4 months late fees. I said, what, when, how? This is what she told the reporter. Quote, why do you have to pay a late fee, Mom? Her son asked. I said, your rent is automatically taken out of your account. So, wow. So it's not even a case where they sent it in. So this is what happens, when you're under the thumb of a landlord, and that's why so many people, they like to own a home. When you own a home, you're not out of the woods yet because you still owe Mr. Taxman, and you still owe, other things you just have to pay for as a homeowner. But yeah, a lot of renters right now getting bullied, and you just have to feel sorry for some of these people. They're basically stuck renting, and now with home prices, you don't like renting? Good luck trying to buy a house because home prices are still way overvalued. All right, let's go on to some other news here. Let's talk about layoffs. We have Petco, which is a San Diego-based animal supply and healthcare retailer. They sell a lot of stuff online. They sell a lot of stuff at their stores. Petco stores, I think it's nationwide, laying off people. So what's happening there? Are people putting less money into their pets? Are people getting less pets now because of the cost and people are tapped out? Very interesting, but we'll have to see how this plays out because you would think that that would be an essential thing. So maybe it's less doggy treats and maybe it's less, fetch toys that pet owners are buying. Speaking of fetch toys, actually, just go to Walmart and get some tennis balls. I used to have a dog that used to love playing fetch, and tennis ball was fine with him. He didn't gripe when it came to that. But yeah, a lot of things you can't buy. You can't really substitute it for lower price. But sometimes people overspend on their pets. I remember seeing some pets with jackets and vests and sweaters and exotic haircuts and stuff like that. Some people really spend a lot of money on their pets. Let's talk about this recent article here out of Forbes. And this headline really kind of tells the story on what's happening out there and how the economic slash financial crisis 2.0 is kind of being covered up and not really reported on like we like to talk about it here. Forbes, as economists see a soft landing, U.S. bankruptcies spike. Economists, they see a soft landing, even though corporate bankruptcies are spiking. A lot of companies out there, too, that haven't filed bankruptcy yet, they loaded up on debt at ultra low rates. Now rates are higher. They're going to have a hard time, one, rolling over that debt, and two, just making the payments on the existing debt because they can't roll it over. So it's a very tough time for businesses. I've always said here since the beginning of the year that I think this is going to be a record year for bankruptcies. Right now, we're on pace, a little more than halfway through the year. We're on pace to be the worst that we've seen since 2010. But I think the second half here, the last 6 months of the year, is going to be worse than the first half. And I think this ultimately is going to be a record year for corporate bankruptcies. We'll have to see how it plays out, but it could be like most of the other predictions here and forecasts that they end up coming true. You just have to wait a little while. On that same topic, businesses here, former Home Depot CEO says U.S. businesses have more uncertainty now than in the past 50 years. We're going back to the early 70s. Home Depot CEO. So why would he be saying that if everything's fine? He says, quote, "I've been at this for 52 years, and I think that I see more uncertainty now than I've ever seen in our country in running corporations across the broad sector of businesses." So he's been involved in several different types of businesses, not just Home Depot. And he's saying that about the economy. All right, folks, we're going to wrap it up. A lot of big things coming up here in the next couple months. We have the BRICS announcement next month. Some people are expecting the announcement of a gold-backed currency. I'm not so optimistic about that. It would be great if it was true. But do you trust countries like Russia and China to actually implement that type of monetary system, one that's actually going to help people and fight against inflation and have the cost of living come down? And those countries would also lose the capability of printing endless amounts of money. Do you really think those countries are going to do that? I hope so. Again, I'm saying that's a good thing if it happens, but we'll have to see. Place your bets. Let me know what you think down in the comments about that currency coming out. Is it going to be gold backed 100%, or is it going to be just a little bit, maybe some trading here and there? Or is it going to be fixed to a weight of gold? If it's fixed to a weight of gold, that's the key right there. That means the currency has to be matching and can be turned in for a specific amount of gold, as in how much the weight is, how many ounces or how many grams, depending on what they announce. So we'll have to see. Also, what do you think about the plummeting manufacturing PMI, and all the other news here, the housing numbers, everything, folks? Please let me know. Otherwise, thanks for being here. Bye for now. Keep stacking. Peace.